Welcome to Regulatory Ramblings. Our guest today is Emmanuel Daniel, founder of the Asian Banker magazine and author of the forthcoming book, tentatively titled The Winning Civilization. It follows on from the theme of financially driven changes that were covered in his previous book, The Great Transition, which was released last year. Much of Emmanuel's writing is based on his experience founding and running TAB Global as a media, research, and consulting house for the past 3 decades. He has extensive contact with leaders in banking and finance around the world and won the Citibank Excellence in Business Journalism Award for Asia in 1999 for his work on the internet and banking. He joins us today to share his views on how emerging fintech and never-before-seen transactions are changing the world order and the power hierarchy as a result. The financialization of everything is a term few have likely heard. Yet, whether we realize it or not, personalized financial technology, or fintech, like cryptocurrencies and blockchain and decentralized finance, have the power to alter how people interact on a daily basis. Through a combination of writing and entrepreneurship, Emmanuel's quest is to highlight how fintech is changing the roles of institutions and markets, while concurrently pointing global society in an entirely different direction. And with that, I will turn to the man himself. Emmanuel Daniel, thank you for joining us.
Good morning, Ajay. Good morning from Singapore. And I've been traveling so much, and I thought that I'd do this interview from a much more relaxed setting here in Singapore.
Much more exotic location, for sure.
Yes. Thank you for the introduction. Very interesting that you started by introducing the fact that I was the founder of The Asian Banker. That was in 1996. And over a 27, 28-year period, I've been a friend of many of the decision makers in banking, traditional banking. And as banking was evolving, I'd always wanted to capture how banking deals with innovation, transitions, and so on. And I think that the first book that I've written, which is The Great Transition, the Personalisation of Finance is here, represents a huge struggle. It took me many years to finally, get that book to print.
What prompted you to go in that direction, though? I mean, tell us about your 2 books. I mean, what compelled you to write these? Because you cover, having read your first book, I had the pleasure of reading it this past weekend. I was provided a copy. You cover a lot of ground that other people have covered. Thankfully, and the refreshing thing is, you do so from an Asian perspective, because I'm sad to say, most of the people that write about this are Westerners. So you offer that perspective, and I'm grateful for that. But the market for these types of books is saturated. So what original contribution did you feel, other than coming at it from an Asian perspective, what original contribution do you feel you could offer? Is there something different in this discussion about the Asian voice, the Asian needs, the circumstances we find ourselves in? Because our region varies in development and levels of wealth.
No, I was not writing from an Asian perspective. I spent months in the US.
Right.
This is probably the only Asian, not only, but very few Asian interviews that I'm doing. Most of my interviews and conversations are in the US.
Everyone knows that you're the founder of the Asian Banker, so it's going to be couched from that perspective. Ultimately, we all bring our perspective to our work.
That's you, expressing a familiarity with me, which is fine. But let me tell you this: that I travel widely. I've been to more than 100 countries, and being able to look at innovation in finance, not from within the US, is bad. And the reason is that there are, many parts of the world. China, for a start, I spend many months a year in China. We have an office in Beijing. We are very successful in China. and I've had a front seat view of the innovations in finance that have taken place in China. And I think the American audience is interested to know what's different in China relative to how the US is, embracing change and tackling some of the issues, especially regulatory issues that it is facing today. I spent a lot of time in Africa, where in the area of payments, I think Africa is way ahead of the rest of the world on many fronts. And when you think about the essence of what payments is the ability to transact information. And if that's what payment is, the technology exists today for payment instructions and transactions to be able to be carried out on the mobile device. And the US is only just getting there. So I'm tackling global issues, and the fact that I'm not American enables me to take a dispassionate view of where the developments are coming from. Now, the second thing that needs to be said about my book is that I am looking at it from within the banking industry looking out. I think that a lot of the discussions on FinTech and innovation takes place from outside the banking industry looking in. Many of the technology players like to think that they're bringing innovations that will disrupt or transform financial services. But because I've been in the industry for nearly 30 years now, I understand the DNA of the industry, and some rules don't change. So, for example, when I take a view on buy now, pay later, as a technology, it's existed within banking all this time. Every time you swipe a credit card, they're able to put a buy now, pay later component into the credit card. So today, the app players come on and say, "Oh, we can make this transaction a lot more, smoother," and they call it frictionless and all that. And therefore, there's a business model in buy now, pay later. Now, for someone who comes from within the banking industry, I'll tell you this, that the essence of the buy now, pay later industry is on the balance sheet of the business, not in the technology. No matter how efficient and frictionless you make a transaction, if your cost of funds is not able to absorb the risks that are involved in buy now, pay later, or if you operate in a country where the traditional banks already have all the good risk customers in that country, you're going to be facing problems in terms of cost of funds, non-performing loans, and customer acquisition costs that is going to come back and haunt you, which is what happened. So my contribution to the innovation in finance is to take it back to first principles and then rework what will work and what will not work, and what the DNA of the industry is. Now, because my perspective is global, and I do need to push you back on the idea that I'm from Asia and therefore my message is Asian. My message is not.
But I wouldn't say your methods are Asian, but clearly coming from here, what the situation is on the ground here. As I was saying, markets here are in different levels of development, different levels of technological and financial sophistication. I don't feel there's necessarily an appreciation of that on the other side in the West, where they think, well, why don't they just implement what we have? And in fact, when it comes to the FinTech debate, in some ways, it's turned the developed world debate on its head, because I think we can agree that there are areas in which India and China are ahead of many Western jurisdictions in terms of payment technology. Now, of course, you could say they were developing markets. They had the ability to learn from others' mistakes. They could implement newer technologies quickly. And in the case of India, they leapfrogged multiple generations because of the digitization of their phone technology and not really building up their phone lines. So but okay, you're coming at this then, as you say, with a global perspective.
Yeah,
and yeah.
there's no need to want to carry the message from any part of the world specifically, because this is a moving target. This is a moving story. The developments that took place in China between 2010 and 2014 that gave rise to Alipay and WeChat Pay does not exist anymore. China has become a highly regulated marketplace, and the regulators have now got to stay in areas like data analytics, and AI and so on. And how China will change or transform in the next few years will be very different from other markets, which may be, less regulated, for example, or get into such periods of, incredible stress that the regulators will allow certain developments that other markets won't. So my job is to go around and look at where both the regulatory and the market dynamics are creating opportunities that will transform us. So, like, for example, last year, I spent some time in El Salvador, looking at how, because of legislation, the Bitcoin is now, currency alongside the US dollar, and how the local population is struggling to, embed that into their daily lives. So, in that context, I'll take a look at Venezuela. I'll take a look at Mozambique, and so on. Countries that have had to make these decisions out of stress. And so now I see also that the U.S. Is going through a very stressful period where, on the one hand, cryptocurrencies and decentralized finance are creating opportunities. And on the other hand, the US, which has been able to grow its economy through the issuance of debt, since World War II, now is coming to an inflection point where the rest of the world is refusing to buy its debt. And it has to work out a mechanism. And I think that it will come through technology and digital finance, where it will continue to be able to export debt as a result of embracing, stable coins and technology like that. So, so it's a moving tale. It's not that if I came from one perspective, that I'll have a contribution to to the mainstream ideas of finance. Now, the mainstream ideas of finance in my original book, which is the Personalisation of Finance, is here. Is that looking back into traditional banking and the DNA of traditional banking, which is predicated on the ability of a financial institution to procure deposits at the cheapest possible rate, and then to redeploy that as loans or as investments. That whole dynamics is changing dramatically. The reason Silicon Valley Bank and Signature Bank, both of which I know personally because I know people in those institutions. I've spoken to the CEOs. The reason they had the crisis that they did and ended up being closed down by regulators is because they were victims of the immense speed by which deposits can be flown out of the balance sheet. And that they didn't have time to respond to getting the asset side of the business rectified. Although they were struggling with that for a number of months before the bank run that happened. And bank runs today don't take place outside the branch. If you look at photographs of Silicon Valley Bank, and there are no photographs of Signature Bank because there were no queues standing outside the branches. When there's a bank run, it's instant, it's all on the same day, and banks have to respond to that. So my contribution to the whole dynamics of innovation in finance is from the traditional banking industry. I know that you've spoken to speakers and writers who talk about innovation from FinTech and from cryptocurrencies. But I start my first principle start with banking as we know it today.
Okay, good point. Noted. So if we come back to the central theme of the financialization of everything, the claim that highly personalized fintech is going to change institutions, markets, and societies and the way they function. That's a pretty bold assertion. Could you tease that out? Could you elaborate? I mean, talk to me more about what that entails and what changes we can expect. Because let me give you a case in point. We're hearing a lot about Web3 in contemporary times. Next week in Hong Kong, we have a Web3 summit. Okay, broadly speaking, I take that to mean the next iteration of the internet and the services and conveniences that will afford us. Well, here's the thing. Most people weren't even cognizant of the transition from Web 1 to Web 2. So they just make use of the technology of the day to the best of their ability. So with that in mind, what substantial changes will take place with fintech and with the financialization of everything? I mean, what practical difference will it make? Because I can tell you in this region, certainly I see in Hong Kong and Singapore, there are a great many holdouts. There are still plenty of people that want to go to the bank branch, meet their manager, take out their money physically. They want to get their statements, their paper statements. And it doesn't, it seems to me there's a sizable minority segment of the population. They're a minority, but they're a sizable number that are holdouts against the coming onslaught evolution of fintech. What are your thoughts?
Well, it's interesting that you put your finger on the financialization of everything, and that's a very good halfway point on the issues that we're dealing with. In terms of the transformation of the banking and the financial services industry, there are macro issues, things that countries and states do, and there are micro issues, things that ordinary people do. Now, the interesting thing about the fact that people still want to go to branches, there are still people who want to hitch a horse-drawn carriage, and then there are people who like to ride a bicycle, and then people who would like to own their own cars, and there are people who would take a 350 kilometers an hour high-speed train. So the whole range of transportation options are available, including the ones that used to dominate society 150 years ago. So I think that in financial services and in any other industry, you would find that that the options to walk into a branch will always be there. It's not something that will go away. Now, the financialization of everything is best described this way. I think it was in 2014 that Jeff Immelt, GE's chairman at that point in time, said that there's coming a point where GE will not be generating income from its traditional manufacturing industry base, and instead from the data that is generated through its through the monitoring of all sorts of supply chain, manufacturing, and Internet of Things sources, and he can envision a time when the balance sheet of GE will be dominated by the data that it sells into the marketplace. Now, anything that can be made into data can be financialized. It's just as simple as that. And today, there are any number of industries, whether it's healthcare, manufacturing, transportation, that are generating all kinds of data. Take the Tesla car, for example. It's a repository of millions of data points, all of which will have the chance to try to be financialized. Somebody may want to buy that data, trade that data, and generate income from that data. When you think about gaming, that's an incredible amount of data points in terms of usage and generating of tokens that can be financialized as well. So we're now entering an economy where whether it's the GDP of Singapore or Hong Kong, and definitely the United States, where the statistics department has started to tweak the definition of GDP to move from manufactured goods to services to software to soft assets like entertainment and so on, and then to even softer assets in terms of financialized data. And it is not inconceivable that the GDP of a country like the US, which is about 21 trillion right now per annum, can swell to about 45 trillion just on the back of financialized data that is traded actively between in different ways in markets, between people who need data and information and so on. So that's what I mean by the financialization of everything, meaning that anything that can be turned into data can be financialized, and anything that can be financialized can be part of the financial economy that is being generated right now.
It sounds like a corollary to what you're saying, that is the commoditization of data.
So the thing about the commoditization of data is very interesting, because what I say in my book, and a lot of people call data oil, the new oil.
And former presidential candidate Andrew Yang certainly called it the oil of the 21st century.
Yeah, and I'm probably the only person who's calling data vegetable. And the reason is, when you have too much data, it loses its value. If you have too little data, it's unusable. If you have data that is too old, it's also unusable. When it's too young, you need to have it mature before it's applicable for whatever reasons. So
it's like olive oil. You have to get it at just the right point of maturity. Yeah.
In the right quantity and right purposes. So the thing about data is that it doesn't have the kind of value that oil has, which is persistent. It depends on when you apply it and whether it's fresh, that is applicable for your immediate use, or whether it is historical and therefore it's for different users and so on. And the interesting thing about data in finance right up to now is that it should have created a value proposition and an advantage for the businesses that ace the data game. So you had trading, for example. When you have high frequency trading, you think that the high frequency traders will then be able to generate more income and be more profitable and be quicker to create opportunities than the regular traders. But guess what happened in about 2014 to 2017? The high frequency traders went through a phase where some of them made lots of money, and then it became commoditized. It became nearly impossible to hold the profits that were generated out of high frequency trading. In fact, today high frequency trading is a de-rigor of the trading industry. If you're not a high frequency trader, you can't participate. But if you are a high frequency trader, you won't be profitable anyway, because it's highly commoditized today. And so that's what data does to us, which is that it commoditizes all of us, so that we need to then recreate our business models to be able to find a value that defines us. A lot of the value that's then generated comes from relationships, from the ability to hold communities together and stuff like that.
Goodwill, which this type of stuff that would traditionally be on a business's balance sheet in terms of valuation noted as goodwill, which is...
Yeah, I mean, and the same thing applies to technology like ChatGPT, which is that it helps to automate the gathering of information, but then it shows up the human being to need to operate at another level altogether. The ability to process information, to create meaning out of it, and that's something that ChatGPT just can't do, and it's not intended to do that. So it's like a calculator, as some commentators put it.
I would cite you one example recently in the South China Morning Post just yesterday. A journalist found that ChatGPT could write an article quicker than he, but it cited questionable sources. In some cases, the quotes were made up, as were the sources themselves. And that said to me that ChatGPT can do a lot. It can compile very quickly, but accuracy is not a given.
So in my book, I make a distinction between the automating of finance and the digitization of finance, and they are two very, very different things. The fact transaction faster, quicker today because of technology and digitizing the information that you have is automation. And automation is a journey from the days of the ATM to processing in branch and all that stuff. And even digital banking should strictly be considered to be automation. Digitization and the digitalization of finance is a totally different topic that is that is within the realm of decentralization, the breaking down of the intermediation business, and so on. So if we make that distinction, then we understand what it is that we're dealing with. When you take a lot of the digital banks that are being created, there are 8 in Hong Kong, there are several here in Singapore, and many countries are now thinking we should allow digital banks to be formed. That's automation. That just makes the process of holding a transaction in finance faster and cheaper, and that doesn't change the balance sheet of the business. In fact, guess what? In the first 10 years of the neobank revolution, all of the neobanks were very good at garnering deposits very quickly. And they used to be very proud of the fact that they could onboard 60,000 new customers a month, and grow the deposit base very quickly. But they were also able to lose that deposit base very quickly to the next player, because all it did was it commoditized the ability to garner deposits. Then you need to look at the other side of the balance sheet, which is what do you do with the deposits gathered? And the strange thing is that on the regulatory front, right after the 2008 crisis, the weakest report in the UK and Dodd-Frank Act in the US, both of them required the Main Street or High Street banks to not have a trading book, to keep their balance sheet to their core business, which is like cutting off your right hand in order to allow you to compete in the marketplace. So because of the restrictions put on high street banks to have a trading book, the fact that technology enabled the digital banks and digital banking in traditional banks to be able to garner a lot more deposits than they would have been if they only had traditional branches. They weren't able to redeploy that capability back into generating income. And that's how banks like Silicon Valley Bank and Signature Bank, not so much Signature Bank, but definitely Silicon Valley Bank and Silver, the other bank that was closed, Silvergate, got into trouble because they were not able to deploy their asset side of the business as quickly as they could have or should have. Instead of lending it out, they bought bonds that lost their value as interest rates went up. So we are now entering a very dynamic situation where technology is making many new capabilities possible, but it hasn't repaired the balance sheet of the banks yet.
Okay, so with those new capabilities, and a big thing that groups like the IMF, the World Bank, Financial Stability Board, a key thing that they're stressing is that post 2008, money laundering rules have something to do with this, high cost of compliance. Vast segments of clientele are being unbanked. When we come to the topic How are these strides ahead in technology helping the cause of financial inclusion, or are they not? I mean, what are your thoughts on that?
I've said this before in other podcasts, which is that when you think about financial inclusion,
Yeah.
being driven by the platform players who insist that what they want to be able to do is onboard millions of customers onto their platform and then monetize them. When that's the business model of financial inclusion, whether it's in Indonesia or India or in China, where you have platform players that want to create platforms that provide financial services and then onboard millions of poor people, because apparently in the past traditional banking wasn't able to onboard them efficiently and cheaply, so they onboard them. But what's the purpose of onboarding them? To monetize them.
Well, in India, it's just about a constitutional right that the ideal is they want even the poorest farmer to have access to banking services.
No, they want the poorest farmer to be on their platforms, and then to leverage the poor farmer to be able to continue, making them incur high interest costs on their loans and to pay for services that, like payments and so on.
Sounds like indentured servitude then.
It is indentured servitude. Now I've studied all the new platforms that are lending platforms in Bangladesh, in India, in Africa. None of them reduce their interest rates to poor farmers as a result of onboarding them. The effective interest rate to subprime customers is still 30%, 24 to 30% per annum. Whereas a prime customer can get a loan or be leveraged at as low as 3%. So the poor are not being emancipated. They are being entrapped, and they are being continued in their need for financial services.
Is it a form of control? Is it
sorry?
a form of control then, that with that and things like the Aadhaar card and wanting everyone to be on the grid, on the system, is it a form of control?
Well, if the idea is to digitize everybody, another way to look at it is that digitization and access to the digital platform is today a human right. Everybody should be given the right to have access to some form of digital asset or digital platform from where they can relate to the rest of the world. But on the other hand, when you give them that access, it becomes easy to control. The poor, the unbanked, the previously disenfranchised. So you're actually onboarding them, and then you call into question the governance of states and the governance of these platforms. What's nice that is happening right now is that the platforms, whether it's a Facebook or a supply chain platform or a bank, they are increasingly being disintermediated, and that's something that I say in my book, by the ability of the individual to claim back a little bit more control over who he wants to interact with, how, and over his own sense of privacy and identity. And so that we are now moving into, I call it the deconstruction of the platform economy. And I've put this idea out to my friends at Google. At first, they rejected the idea. They said, no, that's not going to happen. And of course, you have the option or the possibility of blockchain making that possible. And blockchain has its own limitations and weaknesses and so on. And then ChatGPT happened. And when you see what happens when you just empower the ability of the individual to garner information very quickly, the platforms start to look like they don't have a hold on the customer anymore or the user. So what's happening right now is, yes, as much of humanity needs to be digitized or given access to the digital economy, and I consider that to be a human right. And why I say that I consider that to be a human right is because there are governments today that say that their citizens should not be given access to cryptocurrencies, for example, or have access to digital assets, or even have a digital identity. Now, that's a renegation of a very basic human right. That governments are taking a position in terms of which parts of their society has access to all the new opportunities and new assets and new wealth being created in the digital economy. I think governments should just push back on making that decision for their people. Yes, it creates a number of uncertainties and insecure situations, but we need to latch that down and try and create governance structures that work. So that's the first part of the digital economy that we need to come to terms with. Then the businesses and the business models that are created from there, now that will have to take a life of its own. So when I say that finance or the financial services industry is increasingly becoming personalized, the cover of my book has a visual of an ice cube. There was a time when ice was something that you saw out of the lakes of Michigan or Boston. And where do you get ice today? You get it in the refrigerator. It's within your control. And that's exactly what's happening in finance today. That the individual is increasingly having control over who he wants to interact with, and for how much and in what way. In fact, the ideal in finance is that you and I will be able to interact with each other, transact with each other, exchange value to each other without an intermediary. I mean, that's the ideal that we have in the back of our mind.
But obviously, it's not going to go that way because the banks are too powerful. They lose out on fees. You disintermediate the middleman. They've got a great deal of lobbying power. I mean, it's been said to me all throughout my life: beware the lobbying power of the banks. This comes to something else though, which is when it comes to decentralized finance. When I think about the ban that China has imposed on Bitcoin, when I think about how the Indian government is now subjecting crypto to AML rules, all crypto to AML rules, the proclamation they gave banks to review all their contracts with fintechs. Coming back to what you were saying, it seems as though they're trying to take that choice out of the hands of consumers, out of the hands of their citizens. What are your thoughts on that?
So, in the same way that when the motorized vehicle, the car, the combustion engine was created in 1901, the initial rules of the road were all stacked up against the motor vehicle. So when Henry Ford democratized the production of cars and put it out into the streets, all of the rules in New York were stacked up against the motorized vehicle because they were slow, they were noisy, they were heavy, they damaged the roads, they frightened the horses, and so on. And within a 20-year period, they just became faster, quieter, more comfortable, and cheaper. And many of those rules, didn't make sense anymore. And today, it's the other way around. All the rules in transportation in New York are all stacked up against the horse-drawn carriage, which was the vehicle of choice in 1901. So I think that what you will see in finance is that all the rules are stacked up against cryptos because governments are afraid as to where we are going with it. And of course, you're absolutely right. Both the banks and big business in general, not just the banks, but also the platform players. Big business would always want to dominate the intermediation game. Now, what's happening with information is that big businesses and the state have been able to dominate intermediation because they had access to information that the ordinary person didn't have access to. Today, because of the information revolution, take anything from Uber to to home delivery, information is now the asymmetry of information has been resolved. In other words, you and I, as users, have access to exactly the same information as the producers of information. So that then changes the balance of power and relationships. Now, as the technology evolves, as we put in more AI into how that information is processed, that sort of changes the game plan, as it were. Now, in the US, big business continues to dominate, and the ability of big business to process information continues unabated. But there's a second ability that big businesses have, which is the ability to garner capital. Now, when you look at cryptocurrencies and the fact that if you take Solana, which is like $40 billion, or Bitcoin, which went up to $2 trillion, and now it's like hovering around $800 billion, each of these tokens are not just a repository of technology, they're also an ability to garner capital to fund a lot of the application developments taking place on that token. So we are also seeing an increased democratization of the ability to garner capital to push innovation, and the innovation is now taking place at the grassroots level because of open source computing and so on. So there's a big battle going on, and I don't want to make it look like that one model will succeed over another. It's still a game in play, and there are several players in that equation: the state, the big business, and the individual. And which of these elements will prevail it remains to be seen. Because of COVID and because of the pandemic that we had in the last 3 years, as I visit many countries, I've been to countries as poor as Burundi in Africa. I'm just amazed how even the most destitute country have state mechanisms or state apparatus that are functioning better than they used to before. So the state players, whether it's a highly developed economy like Hong Kong or Singapore or the US, but also dysfunctional ones, the state has become an important player in that equation. And we will see how. And in some places, the state does owe its people the responsibility of building infrastructure so that they can operate, they can function, whether it's in finance or in transport and so on. And then comes the role of the big businesses to be able to monetize that and to invest in technology and so on. And then the individual has to figure out how he benefits from these players, or how much control he wants to give himself. So these are the equations that I think about in my book that goes back into the first principles of finance and where it's heading.
Okay. So when you say these, for lack of better terms, developing jurisdictions, some like say backward jurisdictions, are functioning better than they used to be, do you attribute that to greater utilization of technology and greater data management?
Greater access to digital technology is enabling the most dysfunctional countries to look a lot better than they used to. That's true, and it's becoming easier to govern because of access to technology. There are countries in Africa today, and definitely India, for example, where as a foreigner, I'm able to get a visa by applying online. And these are countries that the administration, the Ministry of Foreign Affairs and so on, are still, totally dysfunctional. It's very difficult for them to get their act together on many things internally. But the one thing they've been able to do is to put out a website and let a third party run online visa application that I can just walk into the country when I arrive.
But there's the economic incentive, right? Because if you make it easier,
and then
more people do it, more people apply for visas, you get more fees.
Absolutely, and it's a source of income. In fact, something that struck me in Africa was that the number of payment players, payment platforms that have mushroomed in Africa is amazing, and they're all immediately cross-border interoperable from day one. Okay, so when Singapore, for example, or Southeast Asia today is trying to get its payments platform going, and they want to call it the ASEAN Payment Network, they are so far behind, the more commercial applications in Africa. And the reason the Africans are able to move very quickly is because they figured out that at the end of the day, finance is information, and if you and I can have this conversation over a Zoom call for free, then you should be able to, to transact money for free as a result. And when you don't have existing legislation and existing legal infrastructure that you need to jump hurdles on, you're able to move much faster than the traditional players. And then guess what? A lot of these new payment platforms in Africa, they are all profitable. They are generating profits, income, which means that there was the hidden income just in the business of payments that didn't exist before. And on top of that, that income now sits in Africa. It doesn't get swiped on a Visa card and goes off to the US and pays some big corporation.
The money multiplier effect within the society, yeah, that's important.
It remains within the economy, and that in itself generates new, economic incentives and economic structures. So it's exciting that that finance is being revolutionized in that way as well. In that finance used to be a facilitator of other creations of value. Also saying in my book is that finance is becoming the center of the creation of value. So banking is no longer an intermediary function. It's a generator of actual value. And the reason for that is that banking is not a intermediator of money anymore. It's an intermediator of information. And anyone who arbitrates information creates value. So that's the transition. That's the huge transition that is underway. The fact that crypto or Bitcoin could go up to 65,000, that wasn't the magic of crypto. The magic of crypto is that you are able to generate your own crypto. I am able to generate my own crypto. Anybody around me is able to generate his own crypto and then put it out there to his friends, his family, his intermediaries, or his counterparties, and hope that his crypto will be accepted for its value. And that's exactly what's going on in the world today.
And trade in a peer-to-peer fashion without the legacy financial institutions. I want to come back to your point about why the Africans are ahead. There's something to be said for the legacy institutions and rules. And if you're an established jurisdiction, that you have to deliberate. You can't just jump into something new. We had a variation of this discussion. We were talking about, okay, a year and a half ago, we were talking about crypto in Asia. The view was, okay, Hong Kong versus Singapore. Singapore is in pole position. Now it's like everything in Singapore everyone's on provisional. Nothing's being approved, and out of this during the pandemic, the dark horse of Dubai arose with VARA, the Virtual Asset Regulatory Authority, the first regulator of its kind. And there seems to be something for the notion that in a new up-and-coming jurisdiction where laws are fluid, laws maybe don't necessarily mean what they mean elsewhere in the world, or they don't have that much law, that they can create things far more quickly. Whereas, again, Hong Kong, Singapore, legacy jurisdictions, established financial institutions, established legal systems, they have to take a slower approach. They have to deliberate. They have to operate within the confines of the systems that they've got. Whereas I mean, I'm not exaggerating much. The law is pretty much whatever the sheikh says it is in the Emirates, with only Dubai and Abu Dhabi having veto power over national level legislation. Power is heavily concentrated and consolidated in that domain, in that realm, in that jurisdiction. So no, that's a valid point. I want to turn to something else that people are interested in, that I know you have a lot to say about, which is the weaponization of money. That the future of war will take place in the financial battlegrounds. We certainly see that with Russia sanctions and the sanctions that have been levied on Iran, gradually ratcheting it up over the years, that we will outright deny you access to the US banking system and accordingly the world. What are your thoughts on the weaponization of finance, and how far can that go before you sanction too many jurisdictions and they start to play amongst themselves?
So the weaponization of finance is absolutely not my idea. It's not a phrase that I would even use, but I understand where it comes from and why it needs to be thought through. The US has weaponized finance very clearly, and that in itself calls into question the continued role of the US dollar as the world's reserve currency. Now, for everyone who thinks that that's coming to an end, or that some other currency is going to take that role, needs to understand first the elements that have made the US dollar the operating currency of the world. And the elements was never because of a set of intentions or design on the part of the US. In fact, the dollar became the global currency precisely because the US banned the dollar from coming back into the US. They exported the dollar, they exported capital through the Marshall Plan, and participated in the development of many countries around the world. And many countries around the world made the US their most desired destination for export, and therefore the dollar took on a greater sense of importance over time. But the fact that there is so much dollars outside of the US, 70% of the dollar circulates outside the US. The US itself has no interest in having that come back to domicile in the US. So that's what makes the dollar the global currency. Now, there is no other country in the world, and definitely not China, that will expose its currency in the way that the US has. Now the US today has a very interesting situation where, because of rising interest rates, many of the countries and its counterparties, or trade counterparties, which have been holding treasury bonds, are divesting them right now. Now, some commentators are using that to say that that shows that the dollar's position as the world's reserve currency is being undermined. It may well just be a trade position in that, when interest rates goes down again and the dollar becomes cheaper, that many countries will find the dollar, the more, or rather dollar assets, the more profitable assets to hold. So it's just a function of markets. Now, and then what have the different countries been doing as a result of the US weaponizing its dominance of the global financial system, by trying to lock in Russia and so on? They've been trying to create bilateral arrangements. So you have one between Saudi Arabia and China for buying oil, for example. But when you look at the mechanics of those bilateral arrangements, they're domiciled in China. In other words, the fact that Saudi Arabia can issue invoices in renminbi to sell oil to China, they have to have a bank account effectively in China, which they then use to buy or pay for the exports that China has towards Saudi Arabia. And all of these bilateral arrangements are between parties that are, the enemy of my enemy is my friend kind of a situation. So we don't have a an operating new model coming on stream yet. There is a desire to push away from the existing model, but the new model is nowhere in sight just now. In fact, guess what? This sets the stage for the digitization of the dollar. And that's where I see the ability of financial institutions themselves to issue their own stable coins that is a reflection of whichever currencies that they hold, whether it's the dollar or the Singapore dollar or eventually the renminbi, and within the security of a regulated banking industry, respective to each of these countries. That's what makes it possible for many of these countries to issue their own currencies and have it accepted globally. So I'm just sitting and watching the developments as they take place, and there's a lot of noise in the industry. There's a lot of backlash against the US for having weaponized its financial system, but the answer may well be in the digital economy that's being created, and not necessarily in the status quo, the real politics between nation states.
Interesting. So picking up on what you said about the stage being set for the US to launch its own stablecoin, what do you see as the future of central bank denominated currencies?
I am probably the only voice in the world today that is saying that CBDCs will quietly disappear. And I say that with the conviction that comes from having visited countries which already have CBDCs underway, talk to their central bank governors, who then tell me privately that the take-up rate is less than 1%. And the challenges that they have fighting their own banking system to make the CBDCs popular, So there is a big difference between a live CBDC project and a pilot. So every time you hear the word pilot, you must remember that that country hasn't gone live yet, and then you have to ask why not, despite the pilots being huge. Now, CBDC's greatest enemy is the stablecoin, and the reason is that when you look at the amount of energy and transparency that goes into creating applications on stable coins, and the fact that you take any one of them, USDC, for example, there are hundreds of thousands of programmers in open source developing applications on USDC or USDT, okay, or any of them, okay, Binance. The CBDCs just can't compete on the amount of technology and applications that are being created on stable coins today. Now then, I monitor very closely the literature that's coming out of the BIS and the speeches that they're making, the Bank for International Settlements. They are taking a very, very serious watching brief on the development of cryptocurrencies and stable coins. If you want to understand the stablecoin ecosystem that's being created and how it should be managed, the best source is the Bank for International Settlements. And the interesting thing is that they've even mandated that they put into place and agreed in November or December last year that by 2015, central banks will be allowed to carry stable coins or digital currencies, cryptocurrencies on their balance sheet from 2025, right? So the stage is being set for greater acceptance of stable coins and digital currencies or other cryptocurrencies into the future. And so the BIS is taking a watching brief and a parallel universe where all of its members, which are the central banks of all the major countries, including the US, have a stated intention to release a central bank digital currency. but at the same time, allowing for the crypto world to develop alongside, and keeping a watching brief to see how these developments will take place. And I think that it's just a matter of time before nation states say to themselves, you know what, it's beyond us to drive this technology. Let the private sector develop, digital currency, digital money. We will just create the governance structure by which these things can be deployed. When we think about the future of money, we're not just thinking about about economic structures. We need to think about ordinary people in every country developing their own applications in order to figure out how they want to transact with each other. And that's happening in cryptocurrencies today. It's not happening in central bank digital currency. And on top of that, central bank digital currencies is a wonderful architecture that disintermediates the very banking industry that central banks depend on. In other words, if the most perfect working central bank currency actually disintermediates the banking industry itself. So then the question is, it's a solution looking for a problem, which is, what was the problem in the first place? And I think that there are jurisdictions like Singapore, for example, which have taken a very sensible approach to say that, as long as we are progressing well on digital banking, which is traditional fiat money being generated on digital platforms and payments being cleared on digital platforms, you don't really need a CBDC. Because it functions well, it still uses the traditional banking system, and it's real time and all of that. Now, the only time you start moving into CBDCs is when you want to create applications on top of them, and that's something that there is not a single central bank in the world that's allowing their people to do that.
Okay, people are very interested in the crypto space now because of the collapse of Silvergate, SVB and Signature, and they're looking at crypto now with a eye towards 2008 and what the ramifications were, the notion of systemically important institutions and how that concept may now be applied to crypto. And crypto for the longest time was regarded as somewhat of a fringe, something on the outskirts of the mainstream economy, but that's no longer the case. So if that can cause bank runs, people are thinking about the next financial crisis, and they happen, every 10 to 12 or 15 years. I think we're overdue for one. When do you see the next financial crisis happening, and what will drive it?
I ended my first book by drawing a scenario as to what the elements of the next financial crisis will look like. And I am very intrigued that within 6 months of having the book released, that's exactly what's happening, which is that it's a financial crisis predicated on the back of a perception of value. It's not predicated on the back of a real asset. The financial crisis of 1984, the savings and loans crisis, was predicated on the back of actual mortgages that sat on the balance sheet of mom and pop banks in the US. The financial crisis of 1987 was on the back of securities. The 1996 Asian financial crisis was increasingly on the ability of countries and large businesses to meet their dollar debt. So you can see that financial crises were evolving from very strong physical assets to increasingly ephemeral assets, trade. By the time you reach the 2008 crisis, it was on the back of the derivative of a derivative. In other words, not even the mortgages, it is on the derivatives of mortgages that are being traded by the Wall Street banks, not even the Main Street banks. And then when you reach 2010, 2023, the crisis that we have seen now with those three banks and then Credit Suisse, none of them had crypto on their balance sheet. It was a perception that they had something to do with crypto, and therefore that we had to had a run.
Because of their clientele.
In the case of Silvergate, yes, the clientele was essentially the crypto players, and there was a fear that the leverage in the crypto industry will come and play back into the books of Silvergate. But Silvergate itself did not have any crypto on its balance sheet. In the case of Silicon Valley Bank, it wasn't crypto anymore. It was basically fintechs and startups. And it was a pure balance sheet crisis, which is that it was so good at garnering deposits on the liability side of its business, on its balance sheet, but so bad at deploying them on the asset side of the balance sheet. And you know something? That Silicon Valley Bank model, it used to work amazingly well in the past. I knew a banker in the US, Vernon Hill, who built a bank called Commerce Bancorp on the back of a model, which is, if I'm efficient in getting the cheapest source of deposits and just lend it in the interbank market, I'm done. I'm set. My bank will be the most profitable bank in the country, and it was for 30 years, for a long time. And then, it closed down a few years ago.
For the longest time, they could do the bare minimum, and their clients were bringing them sacks of money multiple times a day.
Yeah, and the whole idea was just keep faith with your customers, have great branches in the right parts of the city, allow people to bring their dogs in, allow small businesses to throw in their coins and give them a coin counting machine and stuff like that. That used to be what banking was, that is, just make it easy for your customers to bring in their deposits. And today it's even easier because of digital banking. And then Signature Bank, and I know Signature Bank very closely because I'm associated with several people in the organization. They do have a number of crypto clients, but the bulk of the customer base was small business Jewish traders in New York City.
Right.
That was a very, very solid bank on the balance sheet. So you're now getting into a realm where bank runs are being generated because of digital on the back of mere perception. And so how do you handle that? How do you, respond to that quickly enough, in order that your bank is not punished? Now, I see a world where one day, and I would like to go on record saying this, that the stable coin business will be the replacement for the traditional deposit business. In other words, every bank in the world will compete with each other on issuing their own stable coin, which is regulated on the back of a real balance sheet and competing on the technology that sits on their respective stable coins. And all stable coins in the world will be interoperable from the start go, because that's what they are today. So the thing is that I dare to imagine that world coming on stream eventually. Those of us who are still trying to apportion blame for the current crisis on crypto need to be told in no uncertain terms that there was no crypto on the balance sheet at all.
Yeah, no, that's a fair point. So when the smoke clears, right? I mean, in terms of the global financial order, what can we expect to see on the other side? Because, I mean, there is the view that dysfunctional economies, not stable ones, are shaping the future of global trade and commerce. So what is the new global financial order? What will it resemble in broad strokes, or as many details as you can give or envisage at this stage?
The financial order that we've become accustomed to in the last 150 years has been dictated a lot by the United States and the decisions that it's made for itself, at the expense of everyone else. And it's amazing how the US has been able to set the agenda for the rest of the world. And it had that ability long before it became the world's reserve currency. And what is the US? From its inception, from the day of independence, it has been a debt-driven economy. In order to fight the wars of independence, it had to issue debt. The Civil War issued debt. The 1913 crisis issued debt. The Great Depression issued debt, and so on. So the U.S. has always resolved its issues by issuing increasingly more debt. And today,
because they knew they would always grow out of it.
They were always hoping that they were able to grow out of it. Last year, the total U.S. debt has now exceeded the GDP of the country. So total U.S. debt is now $31 trillion, and the GDP is $21 trillion. So the ability to grow out of debt is now a moot point. The focus now turns to the ability of the rest of the world to invest in U.S. debt, and that the U.S. will work for the rest of the world by making sure it keeps its commitment on its debt, and it needs to be able to do that even more efficiently. And that's why I think that the U.S. will eventually embrace digital economy or digital finance as a way of enabling the rest of the world to participate in its debt. So I think that that's what I mean when I say that it's the dysfunctional country that dictates the future of finance. Okay, and that's exactly what the U.S. did in 1971. If you look at all the literature and all the discussion among the most prominent economists,
the gold standard.
Was the gold standard right up to 1971, and then
it was the 30 glorious years. It was the 30 glorious years after World War II.
And they were serious about keeping to the gold standard, and the U.S. would not even allow any other country to try and find trade-driven models. The UK was looking for a trade-driven model, and all the literature in the U.S. at that time was that let's keep to the gold standard. Until the U.S. itself could not meet the gold standard, one fine day Nixon goes on television on a Sunday evening and says, "You know what? We're going to just let our currency float." And that was a breathtaking act, because the U.S. could have gone under, or it could have aced the global economy. It aced the global economy because it is the largest consumer of goods and services in the world, and every other economy wanted to continue exporting to the U.S. And so what did all the other countries do? They packed their currencies to the U.S., therefore strengthening the dollar. Now, where we are right now is that the appetite for U.S. treasuries has gone down dramatically, even among its allies. Switzerland has been deleveraging on treasury bonds, for example, and so there's a need to be able to continue exporting that debt. That's the scenario in which the U.S. will make its future decisions, regardless of the sessions that you and I may be watching on Congress, the Financial Services Committee, taking a watching brief on where technology is going and where the fraud is coming from. All of that, to me, is noise. It's what the U.S. is capable of doing when it's run out of options. So I always say that the U.S. will say no, 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 and then do exactly what it wants to do. So that's my perception based on the historical role of the United States. Now, which other country is capable of creating a financial order that the rest of the world can subscribe to? I think that almost every other country, the strong economies of the world, are taking a defensive position. The Singapore government, for example, has got absolutely no intention of allowing the Singapore dollar to be floated freely outside of Singapore. And that is why
it's a managed float, isn't it? As of right now, it's a managed float. Yeah,
managed in a way that there are no stated formulas, but it is managed with a view of keeping prices constant in Singapore, right? Now, and it's for that reason that technologies like blockchain are of great interest to small economies like Singapore, because it gives the perception that the currency is widely available, but the regulators and the central banks able to track exactly who's holding the currency and using it, and for what they're using it. So that's for that reason that many countries, France, Canada, and even Hong Kong, are interested in blockchain technology for the seeming liberalization of their respective currencies, but actually gives them greater control than they have even now.
It's interesting you mentioned the gold standard, because I remember at the time, I think it was either Secretary of State Kissinger or Treasury Secretary John Connolly who told a French diplomat, the dollar is our currency, but it's your problem. Clyde Prestowitz, who was aide to the Secretary of Commerce during the Reagan era, Clyde is with a think tank in the US. He wrote 3 Billion New Capitalists. And his point was, he remembers, he was a college student in the 60s, and he remembers on Friday nights, Saturday nights, the business news broadcasts would announce how much gold had been repatriated from the US to whichever country. So, yeah, I mean, going back to your point about how ultimately it became unsustainable for the US, yeah, I mean, that really drives the point home. But yeah, it was a period of tremendous growth and price stability. And yeah, I don't think that age is ever coming back. So in the time we've got left, is there anything else you want to add, anything else you want to say that you feel we haven't discussed that needs to be spotlighted? Anything?
We started this conversation trying to contextualize where my ideas are coming from and why yet another on the future of finance was necessary. I hope that anyone watching this, your listeners and your viewers watching this conversation will understand that what I'm trying to do in my book, The Great Transition, the personalization of finance is here, is to go back to first principles and then work out where the global economy is going and where the future of finance is taking us. A lot of what is happening is driven by technology, but we need to take into account the global financial construct or the structure by which the global economy works. The reason the US will continue to dominate, and just to build on the point that you made, a lot of it has to do with the fact that the US doesn't care what happens to its currency when it's outside its own economy. And every other country cares. So big difference between the US and the rest of the world. And until that formula is broken down and the US cares too much, because of whatever reason, there has to be a fundamental shift in the US psyche for it to think differently. Then I'd say, okay, we need to look at what the options, how the other options are evolving. I continue to develop my thoughts and my ideas, and because I go back to first principles, I'm able to think through not just the technology. I look at community currencies, for example, and their role, and how that's I see a linkage between community currencies and gaming, for example. I see developments taking place in microfinance that can be digitized, and so on. So there's a whole realm of developments that we're able to project if we go back to first principles. So I want to thank you for this opportunity to have this conversation with you.
Thank you for joining us, and we hope when your new book comes out, you'll come back again.
Very much. Thank you, Ajay.
Emmanuel Daniel, thank you for joining us. And to our viewers, thank you all. Until next time.